Hi, it's Lee, and welcome to the Tesla Economist. Another green day today for Tesla. Actually, not too far off $200 now. Would be nice to be back over that. Of course, unless you're still buying, which I'm sure there likely aren't many left. And we probably bought everything we could find when the price was in the lower 200s, as it seemed like such a good opportunity. And I don't think we were wrong either. Just unlucky perhaps. Which is why overall we invest, not trade, as that does remove the necessity for luck when it comes to the market. Whether you bought at 250 or 180, when the stock price is at 1,000, the relative difference starts to dwindle. It would appear that Tesla will always continue to surprise us with these crazy price drops. So perhaps in the future, it might be prudent to keep some cash for next time. Except where are you going to get this cash? If you're like me, then only from selling shares, which means you would have to sell the stock at the most exciting times, which, as Tesla bulls, tends to be very difficult. I think we can all agree, though, that this was bad luck, as I would say we have likely lost something in the region of perhaps almost $50 from the stock price due to Elon selling. That's a lot. For many, Elon has cost us millions of dollars, and I'm pretty sure he was selling again today, looking at the volume and comparing the rest of the market, with Tesla being down about 3% around the start of the day. And we don't even know if he's finished yet. As you know, I'm an analytical investor, and I like to use as much math as I can to grasp the reality as to what is happening with Tesla's stock price. And right now, we've recently seen new 52-week low. Yes, Tesla recently dropped to around $175, or $525 at the pre-split price, if you can believe that. A growth company, still growing at an exponential 50% a year, and closer to 70% for 2023, and that's just vehicle production. Profits will be closer to 100% due to operating leverage and in-house battery production, and at a P ratio of around 30 relative to this quarter's earnings. The market is rallying as if inflation is over, that the Fed managed to finally get it under control, and we saw 0.3% increase in inflation in October, down from 0.6% in September from August. The Fed have broken the back of inflation, supposedly, although 0.3% is still pretty high, but obviously a lot lower, and closer to where we want to be. But we still want to be about half that rate again. In other words, inflation is still high, but this did come below expectations, and people infer it to mean that the Fed will not need to be as aggressive with interest rates in the future. Anyway, it was still a relief to see it reducing, and that potentially things may get better. And yes, of course, energy prices are creating supply-side inflation too, and we can only hope that improves too. Although don't forget that Tesla have another side of their business that is energy too. And there is a new factory up and running and finally producing megapacks using lower cost LFP cells and Tesla's amazing advanced manufacturing skills. The batteries will not only be in higher production, but much lower cost with great margins. And demand for those is also unlimited. Had enough of me defining Tesla as unlimited demand? Well, who can't afford megapacks when all they do is save you money? What consumer can't afford to buy things that save them money? Hence, unlimited demand. And we're not even close to the production capacity of megapacks or energy storage. This new factory supposedly has a capacity of 40 gigawatt hours a year, and we need closer to 100 times that a year. Hence, unlimited demand. Although historically, Tesla's capacities are sometimes significantly higher than they initially state. But energy is just an additional bonus next year. Vehicles are still the lion's share of this company. The end of the year's run rate is already at 50% growth from this year, with 2 new factories about to ramp up to volume production, increasing margin significantly. Currently, these 2 factories are really pulling down margins. Once they get ramped up, they will generate the highest margins than any other factory. For one reason, due to their advanced manufacturing capabilities, they can simply produce the vehicles at a lower cost. The other reason being that, again, due to their advanced manufacturing capabilities, they can make better vehicles that are of more value. In other words, a product offering more value, which consumers are willing to spend more on, yet produced at a lower cost. The vehicle ramping we will see next year is the ramping of vehicles that contain a lot more profit. Probably something like twice as much gross profit per Model Y from Texas as one from Shanghai, and that's before the price drops. And with a tax credit and battery subsidy too, so possibly even more than twice as much. This is not tough maths, resulting in pushing average margins up rather than pulling them down. And Tesla just sent 200 employees from Shanghai to upgrade Fremont. What did Tesla recently do in Shanghai? upgrade the lines to increase the production rate around 30%. So perhaps they're going to do what they can to increase production in Fremont too. I would say it likely mainly for standard range Model 3s, or possibly a new Model 3 variant, mid-range version, that is low enough cost to qualify for the tax credit, and Tesla can increase production rates there. We have in the past had Elon say Fremont is capable of 1 million a year, yet we're only at around 600,000 now. Tesla wants to really increase production in the US for this tax credit. I really don't think people understand yet the scale of this and what it will do to demand. Well, just don't forget I warned you. Now, all this increase in vehicle production, well, it increases vehicle deliveries too, but due to some crazy aspect about Tesla that seems to happen is although they continue to increase production and deliveries, well, OPEX barely seems to move, resulting in the OPEX per deliveries reducing continually. Hence, part of the reason Tesla have such a high operating margin, especially when compared to the competition. I don't know how they do this, but numbers are numbers, so that's what we go by. This means that there is still a massive $6,000 to come down in Tesla's operating expense per vehicle. $6,000 more operating profit per vehicle to come. Granted, we still need to increase production threefold to hit that level of economies of scale, but it's coming. That would increase operating margins a further 10%, from about 20% to 30%, possibly higher if Tesla start hitting 40 to 50% margins with their new vehicles. Elon recently said Tesla will hit 40,000 vehicles a week by the end of this year. With some quick math, that puts at around a P ratio of 25, equivalent to the end of the year run rate. Note, that's the end of the year run rate, not Q4. I repeat, 25, a P ratio of 25, the same as Apple at the time of this video. And like I said, Tesla will likely have 100% increase in earnings from 2022 to 2023, possibly more. Sure, assuming no major events that stop production or sales, etc., assuming reasonably smooth sailing. So if that's the case, we're at a P ratio of around 13 relative to the run rate by the end of next year, if the stock price remains where it is today. But we're only talking about vehicle growth here and energy. Don't forget the cliche fanboy statement that Tesla is not just a car company or even an energy company. Well, it's certainly a technology company too, except the technology isn't even complete. Tesla can't even take full payment when people buy FSD, let alone it actually passing regulation yet for people to actually have FSD in their cars. But we're close too. And that alone pivots Tesla from an EV company into a monopoly in the AV industry, thus increasing demand, profits, and a whole lot more. And then ultimately, this technology goes all the way to robotaxis, multiplying profits of vehicles by 15-fold. Vehicles that produce 15 times more profit once this technology is complete. Yet we are at around an end-of-the-year P of 25. That's the insanity. You know, if you believe robotaxis will become a thing. But from an asymmetric standpoint, if you think it's more than 7% likely, then it's a positive investment. Alright, perhaps you think robotaxis are a long shot and not willing to risk your money on that. Well, like I said, the market hasn't seen it that way either. Whether you believe it will happen or not, there's no denying what Tesla is doing with the latest FSD beta versions is mind-blowing. No one is close. Close doesn't even begin to describe where they are. It's not going to happen for anyone else. Tesla is alone in this market. If anyone else wants FSD in their cars, they will have to license it from Tesla. No way around it. And if Tesla end up delivering this to consumers at the lowest cost available in the form of robotaxis, at a price even buses can't compete, then that's the end of most legacy autos. Anyway, my point is, all the right signs are pointing to it coming to fruition. And I would say Tesla are leading the way, but that would imply that others are following. And back to that Tesla isn't a car company cliche. I am more of the opinion that Tesla is a battery company at its core. All its products require batteries, energy storage, vehicles, even the bot. Yet Tesla don't really make their own battery yet, except they have recently started and the production rate is increasing at high exponential levels. It's not going to take long until they really start showing some noticeable numbers. The lowest cost battery cell in the world that also has the highest energy density to go into the vehicle that is the most efficient at getting range and performance. Tesla's core business hasn't even begun. These cells will be at a higher production rate than any other cell in the world too, meaning that Tesla can grow faster than any other EV company. Tesla will also mine and refine their own lithium, and likely nickel too, manufacture their own anodes and cathodes. No one can hold them back. They've taken care of all limiting factors in their ability to scale, unlike any other EV company. This will mean Tesla's compounded annual growth rate will maintain throughout the decade. Yes, the rest of the decade we should see this growth. Growth in sales and vehicle production, but also operating profits due to improved manufacturing and technologies. Then we have the next generation vehicle at half the cost of a Model 3. This simply means much higher profit margin to come. But we don't yet know what the business plan is for this product, and whether it will even be for sale to the public. And admittedly, things are not looking great in China. Even despite this latest price drop, Tesla are now offering a $1,100 discount in China to vehicles and inventory for the insurance. In theory, the worst this means for Tesla is that they will lose some additional margin for their domestic sales in China. This is likely due to the economy, not Tesla itself. This issue can somewhat be rectified through the logistics of exporting these vehicles to where the demand really is. But if it's that bad for Tesla in China, and Tesla are lowering their prices there, then it just gets worse for everyone else. As not only will they have the economic issues to face, they will now also have the issues of lower cost Teslas to compete with. Remember, Tesla has this amazing pricing power to get them through these sorts of issues. I'm not just talking about other EVs, but ICE cars there too. Bear in mind though, Tesla ramped production in China recently, which will reduce cost, and OPEX per vehicle is reducing as more vehicles ramp. So although gross margin may be down somewhat, operating margins may not be affected as bad. Although there is also the stronger dollar too, which isn't helping. Although it is improving, Tesla just need to concentrate on the logistics of exporting more, which hopefully is getting easier as we get further out of the COVID issues. But yeah, China is not without its risks, along with lockdown still. But the future of this company isn't China. Anyway, I just stick to the math as usual. I don't have a crystal ball as to what the market will do, but I can do enough math to try and predict what Tesla's revenue and profit will be, and I've been fairly accurate as to its growth over the years. And that was before I expected EV demand to increase so much that Tesla could increase their prices significantly. Oh, and Tesla's Model Y production to be at 3.5 times as much as they initially stated the capacity. I'm just trying to do what I can to maintain being level-headed and ignore the noise and insanity out there. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.